welcome to the podcast, everybody. Thank you for joining me. We are sitting here with about an hour and a half to go before the market closes, and I wanted to get this out to you. I've got some other things going on, but I did want to get a podcast out. Really, really ugly day on the markets following a really, really excellent day yesterday. So depending on which side of the trade you're on, of course, because if you're short yesterday, you're having a really bad day, and if you're long today, you own stocks, you're having a really bad day. So it just depends on which side of the trade you're on, but we're getting the seesaw. And before we get started, just a reminder, if you want to, go to the websites eggerscapital.com. And, of course, we got the Facebook and Twitter and all that stuff, Twitter throughout the day. And right now we're looking at the Dow Jones down about almost 300 points. It's been down a little more. This really stands out to me, very similar to the 2011. If you recall, back in the summer of 2011, our debt was downgraded. We lost our AAA rating. And during that time, the Dow Jones had 4 consecutive days of 400-point moves. Now, at the time, it was much different because those were 4% moves, as opposed to what we're getting now is not even 2% because we're obviously higher. We're almost 17,000 on the Dow, 16,000 now. But as we look at this, the seesaw back and forth, and you can see it here, these long bars. So we've been in a downtrend, but we've had a couple of big up days. So we're getting the volatility back. We're getting these 1.5 to 2% moves back and forth. And again, I want to stress this, and many of you know this because I've pointed it out numerous times. But a stock market, the average decline in the middle of a year is 14%. Okay, and the Russell 2000 is approaching that, but the Dow Jones, the S&P, the larger cap indices are not anywhere near that. So we haven't had anything like that in quite a while. So I believe that a lot of you are feeling more like this is a bigger move than it actually is. And the reason why is because we haven't seen anything like that in so long. So when you get a 2 or 3% move, it feels really large. So everybody's a little more sensitive to it. But again, I don't necessarily sense overall panic, but there's certainly a lot of stocks down 3, 4, 5% across the board, and it really doesn't matter if it's a high-quality stock or not. One of my favorite stocks out there is Dow Chemical, down 4%. It actually got an upgrade yesterday, and yet it's down 4%. So you're seeing the selling across the board, and you can see the Dow Jones here kind of coming close to the 200-day moving average, which is sitting at 16,591. So we're about 20 points away, 10 points away from hitting that. And if we look over at the S&P 500, you can see we broke this trend this uptrend we had been in. We definitely broke it, and now it appears like some of these moving averages will cross. So we're going to have the 20 crossing the 50 and the 50 crossing the 100, and then we start to look at the 200. We do have a line in the sand here, this level here at roughly, let's call it 1925, whereby if we look at an hourly picture the last several days, the market's bounced off of that. They bounced off it again yesterday, just perfectly. And then, of course, we had the Fed minutes come out that showed that they were going to be, at least the perception was they're going to be dovish, meaning they're going to take a lot longer to raise interest rates. So the market spiked on that, and then it's given it all back today. Was yesterday justified and is today justified? In the big picture, what's happening is there is a question about global growth. Global growth is slowing. The IMF came out and said global growth is slowing, and we're not seeing, even though the central bankers are talking about, well, we may keep rates low. Europe and Draghi are saying the same thing. Even though they're talking about these things, the market is begging for action. It's addicted to stimulus. It's addicted to bigger stimulus programs, bigger quantitative easing, keeping rates low, injecting capital into the system. That's what investors are used to the last several years, and that's what they want, and they're throwing a hissy fit right now because it looks like global growth is slowing and nobody's doing anything about it, which is silly, isn't it? But that's the way it is right now. So what you're getting is this sell-off, and when you look at things like oil, and this is through yesterday, oil actually today has closed at the lowest level since December of 2012. So oil has broken. It is definitely, it's down. It's in a bear market. It's down over 20% from its high. And again, when you go back, and we did some charts on this on our blog, on our website, eggertscapital.com, over the last couple of weeks, showing technical levers and if they broke, what would happen. And we said it could break and have an 8 handle on it. And, this thing could continue to fall. And again, the fear is that it's not just about the U.S. dollar. It is about global slowdown and deflation. And if we see that, we know what happened in 2008 when we saw deflation and a global slowdown. There was nothing the Fed could do or anybody. It had to run its course. So that's the fear right now. And we are seeing the dollar, of course, has been reversing the last couple of days based on the Fed acting, at least saying they're going to be more dovish. But again, today, what caused it? Well, who knows? But you did have some comments by some Fed people, one way or the other, talking about what they're going to do with interest rates, and some want to raise it sooner than later, some don't. Who knows? And to base your portfolio off what the Fed may or may not do is silly. It all does come back to profits. We got a good earnings report from Alcoa last night, and then of course Alcoa goes up this morning and reverses, and now is sitting down on the day about 4.5%. But it was a good start to the earnings season. But it doesn't matter. This is about supply and demand. When you see this indiscriminate selling, it's about supply and demand. We own Ford in our tactical model. We went and actually nibbled on some more today because we think Ford is I don't want to say screaming buy, but I think it's a good long-term investment. You can see it broke trend here, and that's why it's sold off a little more. But this boils down to fundamentals, folks. This is a 3.5% yield, a PE of less than 8. And what's happening right now with Ford is they are spending a lot of money completely redoing all of their facilities. They're completely lining up for these aluminum vehicles. It's costing them a fortune to do it. And so, of course, things are going to be a little slower in the short run as far as their expenses and a little higher. But we think 2015 is going to be a big year for them, and we just think this is a stock that if you can be patient with it, not as a trading stock, but as a stock you can be patient with, this is going to have a great return for the next several years. And, under $14 is crazy. So we did own a hefty percentage of it, and once it started to roll over here, we did take off half of that, and so we've just added a little more back. We're not back up to where we were, but if it continues to fall, we would buy more. And there's a lot of stocks like that. And so you have to determine the number of stocks that you want to own, how you want to own them. Do you want to trade them? Do you want to, simply own them as an investment? What do you want to do? But really, this market right now, this is where the rubber hits the road. Do you want to, when you look at some of these things, like the Russell 2000 here, which is close and broke through support, is this something that you want to be a part of? Because if you're an aggressive investor, by definition, you should be tactical, meaning you should be looking to acquire stocks when they are being sold off because everybody else is freaking out. That's what being tactical, that's what being opportunistic and being aggressive is all about. So are you that person, or are you the person that says, I don't want to deal with that, and I have a pain threshold, and when I get past that pain threshold, check me out. I don't want to mess around with it. And we manage strategies for all different types of people, and you have to determine where you fit on there, and not necessarily where you feel comfortable, but where does it make financial sense for you? Are you needing to earn higher returns? And if so, you have to put up with a little more volatility. Nobody makes money in the stock market without going through these types of episodes. But you can see the Russell 2000 is one of these where the averages have already rolled over, and it certainly looks like it's rolling over. But we are at this support. A lot of my indicators are very, very stretched to the downside. And the way this market's been going, don't be surprised to see, a big update tomorrow. Who knows? But this is what volatility looks like, and it's still small in the big picture. But as we've mentioned before on the show, I think on the radio show, we may have mentioned on podcast, there's a lot of stocks in the Russell 2000 and even the Russell 3000, which is 3,000 companies that are down over 25%, a lot of them. And so there's a ton of companies that are in bear markets right now. Some of them are justified, some of them are not. So you have to determine that. We are seeing a move into gold, and as the dollar, of course, got to that high level and reversed, You saw gold turn around, and of course we got the support at these 3 levels back in July of 13, January of 14, and now. So watch gold. It's been working the last few days. The gold miners have been all over the place based on the fact that yesterday they had a huge day. A lot of them were up, anywhere from 6 to 10%, and then they're giving about half of that back today. So continue to watch the gold miners. And then take a look at interest rates. They're actually fairly flat on the day. If we take a look at TLT, it's actually down on the day. So you would think there'd be a flight into Treasury bonds, and there hasn't been today. So that's an interesting development. I'd say the other one that's kind of interesting is the fact that the emerging markets have been outperforming. We're bullish on the emerging markets, and again, they're getting hit. They're down 1.6% today, but relative to the S&P 500, the Dow Jones, they're actually holding up better. So we think they offer a better value. Longer term, we're talking, not necessarily the next few days or weeks, but longer term. So, but it's not an easy market, but I think, again, you have to determine what's your pain threshold and let your systems work. This volatility we've been going through is just volatility. It's nothing yet that would say, hey, hit the eject button on all this stuff and let's get out. But again, if it's keeping you up at night, you probably do have too much in stocks. But this volatility is something that is part of the game, and but nothing so far has changed our opinion of what's going on. The only thing that has happened is that there's definitely some signs of an aging bull market in the sense of how many stocks are starting to roll over. When you look at the number of stocks going up versus down, all those types of things, there's no question that when that starts to happen, the market's starting to look tired and selective, and that's exactly what we're seeing now. But again, until proven guilty, this thing is innocent. And right now we're getting some volatility, but these are the types of days that if you don't have to sell, you don't want to sell on a day like today. You need to be nibbling on a day like today if you can afford to do so. There's going to be a time to sell. And again, if you can't afford to hold on to these things, absolutely sell. But if you can't afford, and this is money for your longer term, then certainly look for these opportunities. And then you want to be selling when this thing bounces up here and then it starts to roll over. And that's maybe what we do get over the next few days and even few weeks, is that we get a market that starts to bounce. And we come up to here, and maybe we make a lower low. Then that would be your time where not only would you want to sell some things, maybe you short. But we have to see the type of demand. We've seen a couple of 90% down days. This will probably be a third one. Those clusters tend to form bottoms in these corrections. So let's watch that. But what we need to see is the second part of the equation, which is the demand side has to come up. And you have to see, just like yesterday, you have to see high volume demand come in. Otherwise, it'll just keep trickling lower and lower and lower. And if you're bullish, that's not what you want to see, or if you own stocks. So keep it balanced right now. But again, this is where it's a real good evaluation of if you're uncomfortable with everything going on right now. Not that anybody likes to lose money, but if you're abnormally uncomfortable, then you probably aren't using the right strategy for your particular situation. But watch these lines again. We've got an hour to go here. By the time I finish this, who knows what the market could do. But for the most part, we've got this line in the sand here, kind of this, like I said, this 1925, which we've hit twice now, came close to it today. See if the market bounces off it. But these 3 days we've been seeing here with the up, down, don't be surprised if we get a little up tomorrow. It wouldn't shock me. Again, a lot of the indicators I'm looking at are extremely oversold, and in my notes would say they are extreme. They are extremely oversold. And when they're extreme, it's a matter of time before they bounce. It's just like too much pressure on something. You let it go, and it floats back up to the top of the water. Real quickly here, we'll talk about Apple. Karl Icahn making some comments today saying, hey, we think Apple's worth $203 a share. And I said, well, yeah, all you got to do is do a reverse split, 1 for 2, and you get $200. It'll double. But, these activists come out. Is he talking his own book and wanting it to go up so he can sell it to you? Maybe, maybe not. Who knows? He says he's not going to pick a fight with them. He says they need to buy back more stock. And so far, things that he's said and tried to convince these boards to do things, he's pretty much gotten his way and on a lot of things. And so I don't know. Apple is, as I said, I think it's a stock that good company. It's going to be, I think, one of the best dividend companies to own over the next several years. Is it a trading stock anymore? Is it a stock that you feel like you can make 30% on in the next 6 months, I don't think it's that type of company anymore. But I do think it's a solid core technology name. Whether you want to own it for growth or whether you want to own it because it's a dividend name, that's up to you. And there are several dividend names that look really good right now. But just watch this stuff carefully. So that's we've talked about oil, we've talked about Apple, we've talked about the Russell, gold, emerging markets. We showed the dollar. Last thing, you show the volatility index up 27% today. It's over 19. So it's getting to these lofty levels, and it's almost to this 21 level, which is where it's been a few times over the past few years, where that's been the bottom. So I think we're getting close to at least a tradable bottom. I didn't really expect yesterday to happen so quickly, but you do see these intraday reversals. But, again, we need to see we've seen the sell side, these 90% down days, heavy volume. We need to see the demand side come in. If we see that, that's the combination we look for to have a sustainable bottom. But for now, it's too early to say this is a bear market or this is turning into anything other than a little more volatility than we've seen before. So, but again, have your systems in place. Yes, there's going to be trading opportunities that pop up. I didn't know 3 days ago I'd be buying Ford today, but I did. But as far as the other strategies that we use, a lot of these things have mechanisms to get more defensive at various times as things go on. And, those things will kick in if this market continues to deteriorate. So you take it to a certain point, and then at some point you say, I know it's oversold, but I still have to liquidate. So it just depends on what strategy you're trying to do. All right. If you have any questions, feel free to email me, carl@eggerscapital.com, and we're going to get back to it. So have a great evening, and we're signing off with the Dow down 306, NASDAQ down 72, and the S&P down 36, all about 1.6 to 1.8%, and the volatility index up 25%, and oil at December 12 lows.